and a bit of reaction. Leslie.
Hey, Andrew. Yeah, it doesn't look too dissimilar from JP Morgan's news. Another top and bottom line miss this morning for Morgan Stanley. That follows in JP Morgan's footsteps and fell short of the street's estimates. You can see there that stock down about 2.5%. Investment banking, a key revenue driver for the firm, that was down 55%, missing analyst estimates for the division as well, thanks to that slump in M&A and underwriting that has really carried over from Q1, although it appears to be even steeper in its declines during Q2. Wealth management and investment management also lower this quarter at Morgan Stanley. The key bright spot for the firm was trading, especially within fixed income, seeing year-over-year growth within that division, thanks in part to the volatility that we saw during Q2. Earlier, JP Morgan reported a double miss as well and said it was temporarily suspending buybacks thanks to the stress test requirements that it had to be more conservative on that front. As such, that stock falling as well. You can see down 2.9%, although it was facing steeper declines earlier this morning. Digging in further to JP Morgan's report, though, that 28% decline in earnings during the quarter was primarily driven by a reserve build, whereas the firm actually released about $3 billion worth of reserves a year ago. Net interest income, the profitability boosted by higher interest rates that banks can charge from loan making, that did see a nice jump thanks to higher interest rates. However, just like its peer Morgan Stanley, investment banking fees did slump during the quarter, about 37% at JP Morgan, though, steeper than its Q1 declines, but better than the 45% declines that management had guided to earlier this year. Markets revenue came in at the low end of guidance, up 15%. And for JP Morgan, those gains were actually driven equally by equities and fixed income. Andrew.
So, Leslie, I mean, you're looking at both of these banks, and now we're trying to really understand the health of the economy, or at least what this says about the health of the economy. I think JP Morgan and Jamie in particular, by suspending these buybacks and the loan loss reserve, plus what's happening in the investment banking business, I mean, you're seeing the market down, what, about 2.5% on both of those? 3%?
Yeah.
The question is this a throw the kitchen sink at it now situation, or this is a drip, drip, drip situation? I think that's what the market's trying to understand.
Yeah, I think what this is emblematic of is just the psychology of the C-suite right now. Because if you look at what's going on a consumer basis, deposits are up, there's decent loan growth, and then you've got debit card and credit card spending that are higher as well. So from the consumer standpoint, this is what we've been hearing from executives for a while now, still very strong. However, the psychology of the C-suite, they're not doing deals. They're not taking their companies public. They're not engaging in kind of corporate financing and transactions on that front. So that has more to do with just the fact that C-suite is paying attention to what Fed officials are doing. They're paying attention to what the market is doing, but maybe not as emblematic of exactly what they're seeing on the ground with regard to consumer spending and how, the bulk of the economy, the consumer spending side of things, is really reacting in this current environment.
Leslie Picker, thank you for helping us break this down this morning. Appreciate it.